Hello, my name is Edmond Jamna, and on behalf of DW Consult, I want to welcome you to Tutorials on the Go. Our zeal here is to help transition people with zero, struggling, or shaky base in accounting to an expert position and to a place of confidence. It is also a platform to assist in the smooth studying of the ACCA and ICA professional qualifications, as well as for any tertiary accounting discipline. All that is required of you is to subscribe to our channel and click on the notification bell as well to be part of the program. Tutorials on the Go, bringing accounting to heart. Now, to this episode's lecture. Associate, IAS 28. So, in a couple of weeks past, we've spoken about the situation where an entity controls another entity, which means that they own more than 50% of the equity capital of that entity, making it a subsidiary. So, in this episode, we are going to look at another form of relationship. So, an associate is an entity in which an investor has significant influence over. Okay, so significant influence is the power to participate in the financial and operating policy decisions without the power to absolutely or jointly control its activities. So for the purpose of easy realization, it is presumed that if an investor holds directly or indirectly, that is through its subsidiaries, from 20 to 50% of the shares or voting power of an entity, it has significant influence. So we're going to look at other situations where significant influence will be in existence. The first is representation of the board of directors or equivalent governing body of the investee. Secondly, when the investor participates in the policy decision-making process of the investee. Thirdly, when there are material transactions transpiring between the investor and investee. Fourthly, when there is an interchange of managerial personnel. And lastly, when there is the provision of essential technical information. We quickly move on to discuss the accounting treatment. Okay, so an associate is not a group company, and so it's not consolidated. It is instead accounted for using the equity method. So under the equity method, the investment is initially recorded at cost and is subsequently adjusted to reflect the investor's share of the net profit or loss of the associate. Now let's talk about how the associate is treated in the group statement of financial position. So the investment in associate is recorded in a line in the group statement of financial position under the non-current assets column. Okay, it is calculated as follows. So we begin with the cost of investment in associate, that is the initial amount the parent paid to the associate. Then we add the parent's percentage of the associate's post-acquisition reserve. Okay, that is the profit after tax. Then if there is any impairment on goodwill, we less it, which will lead to the figure. Let's test our understanding. So Portia bought 40% of the share capital of Arnold on 1st January 2015 for $400,000. Alex's profit for the year were $200,000. An impairment review was carried out at the end of the year, and the investment in Arnold was found to be impaired by $15,000. So we have to calculate the investment in associate to appear in Portia's financial statement at 31st December 2015. So for solution, the investment in associate, the initial recording will be the cost of investment, which is the $400,000. Then the profits for Arnold was $200,000. Portia holds 40%. So when we strike it, the parent's portion will be $80,000. There was an impairment on goodwill of $15,000. We less it, which will lead to an investment in associate of $465,000. We move on to the group statement of profit or loss. The share of the profit of associate is what is going to be recorded here. The share is going to be calculated as follows. So we pick the parent's percentage of the associate's profit after tax. Okay. Then if there is any goodwill impaired during the year, what we saw previously in the group statement of financial position, we will less it from this figure, which is going to give us the amount to be recorded in the group statement of profit or loss. Okay. So this figure will be shown immediately before profit before tax. We move to intra-group transactions. We'll first look at trading transactions. So here, transaction amount and balances are not to be eliminated, as with the consolidation of subsidiaries. Therefore, sales and purchases are not to be removed from the group statement of profit or loss. Neither current account balances, that is receivables, payables, from the group statement of financial position. We now come to unrealized profit. So here, only the parent share, that is the percentage holding, of the unrealized profit is to be eliminated from the group account. Okay. Then the earnings of the seller must also be adjusted. Let's now look at unrealized profit adjustment. So we're going to look at the situation where the parent sells to the associate. So if P is the seller. So here we'll have to increase the cost of sales of the parent in the group statement of profit or loss. Then we'll eliminate it from P's retained earnings. Then lastly, we'll eliminate it from the investment in associate. Secondly, if the associate is the seller, we'll eliminate the unrealized profit from the parent percentage of the profit after tax of the associate in the group statement of profit or loss. Secondly, we'll eliminate the unrealized profit from the parent inventory in the group statement of financial position. Then lastly, we'll eliminate the unrealized profit from the investment in associate. Okay, let's finally test our understanding. So Preston owns 40% of the share capital of Austin. Preston sells goods to Austin for $5,000, making $1,000 profit. Half of the goods have not been sold, hence still in inventory. So what entries are required in the group account? For solution, the total profit in the transaction is $1,000 as stated in the question. Then the unrealized profit, that is the profit on the amount unsold, is $500. The question stated that half of the inventory were unsold, so we just find half of the total profit. Okay. Then the amount necessary to be adjusted is $200. So what we do is that we find the percentage of the parent, that is Preston, in the associate Austin. Then we strike it on the unrealized profit. Preston has 40% of the share capital of Austin. So when we find 40% on the unrealized profit, it will be $200. That is what we are going to adjust. So for adjustment, we'll increase the cost of investment of Preston in the statement of profit or loss because he was the one who did the selling with the $200. We'll come and decrease the retained earnings of Preston in step 5 if you're supposed to do consolidation, $200. Then because the associate was the buyer, we'll decrease the investment in associate for the same $200. Okay. So folks, this is where we draw out the curtains on our lecture. If you have any comment or feedback for us, do well to drop them in the comment section below and it will be timely and adequately addressed. Whilst at that, kindly subscribe and turn on all notifications to stay abreast with our uploads. Also, follow us on our various social media handles as captured on the screen. So we come to you by way of another episode of Tutorials on the Go. Take care of yourself and stay blessed. Poker.